welcome back to our YouTube channels. Our topic for today is to hedge or not to hedge. This is a common question by many of the retail investors. So I'm going to come from the perspective of a retail investor. So our topic for today is to hedge or not to hedge, a retail investor guide. So I'll let you know in what circumstances you should hedge, in what circumstances you should not hedge. So I'm going to guide you from overall perspective, and I'm going to use very layman perspective to explain to you, because I know that this topic itself is not easy for many of the retail traders. So I'm not going to use any jargons, and I definitely will avoid to use that, and I will explain in a very simple perspective. So before I start, as usual, if this is your first visit, please remember to subscribe to our YouTube channels and on your notification bell. My name is Ting Ting. As usual, before we start, we need to do a disclaimer. Our topic for today is only meant for education purposes. There's no buy or sell call. Now, we need to understand the first concept about what is hedging. We have many topics previously I already covered about hedging itself. If you do not understand, you can go and check it out, some of our videos about these hedging topics. Many of the topics we discuss in details about hedging itself, but today I'm going to use a very simple statements to summarize exactly what is hedging. So hedging is like as simple as like you are buying insurance. So let's say, for example, today if you worry that suddenly in one day you're going to so-called lose a lot of money, because you're going to put those money into your medical bill, or you're going to pay out something, for example, to buy a new car because your car was being damaged, for example, or caught in an accident, etc. So hedging is like buying insurance to protect. So in a way, the objective of hedging is very simple: to reduce our risk. So as a layman perspective is how we are going to reduce our losses in trading. I'm not going to go for very difficult terms like, for example, infrastructure risk, market risk, price risk, etc. So as simple as how do you reduce your losses when it comes to trading. So the rest in details about what is hedging, you can view all our previous video related to this particular topic. Now, my focus for today is we are going to go with like in what circumstances we should hedge. Our focus is when we should hedge, or whether should we hedge or we should not hedge. Now, before that, we need to understand what are the common hedging tools. What are the tools? Because if you are going to hedge, you need a tools. Like for example, if today you want to repair your chair, your broken chair, you also need a tools, either a screwdriver, a hammer. So when it comes to hedging, we need the tools as well. So basically, there are many hedging tools, but I'm going to summarize into three common or three main or major hedging tools. What are they? The first one is futures. So this particular topic in terms of futures, I already covered many of the topics itself. You can go and view back. For example, if today you're having your stocks, how are you going to hedge? So for example, you can use FKI to hedge. So this is what we call as your futures, using futures as your hedging tools. Another method, this is more common in Malaysia, where people are using futures to hedge. Or another ways is like, for example, for commodities itself, they are using futures as well. For those physical players in the market which they have so-called as commodities itself, they are using FCPO to hedge against the physical itself, those palm oil, for example. Now, second part, this is not common in Malaysia because the liquidity in terms of option is relatively low, but option is another method for you to hedge. It's one of the hedging tools as well, especially in many of the countries. Many of the traders, they tend to use option as well. Now, the third hedging tools, to your surprise, many of you don't perceive this as one of the hedging tools, but in fact, this is one of the hedging tools, which is portfolio diversification. And portfolio diversification is a proven method. So long as you diversify your portfolio, definitely you're going to reduce your risk when it comes to trading. So this is definitely a proven method. And if my own perception is, if you do not have knowledge when it comes to hedging, it's better that you don't do any hedging, but you can use a simple method like portfolio diversification so that you can reduce your risk. But definitely learning the tools of hedging and use the correct strategies to hedge, that will be more precise, and your chances of winning it is definitely higher. Your chances of making it or doing correctly is definitely higher. But really, if you do not have any knowledge, I would definitely encourage you to go with portfolio diversification. Now, the next question is whether should we hedge or should we not to hedge, or do we need to hedge or we should not hedge? That is the next question. So before you can answer whether should you hedge or you should not hedge, these are the three main factors influencing your decision. Now, what are the three main factors? The first factor is the most important. I'm going to give you a more direct route rather than you're going to go through a longer route. You know that my style is, if you have a shorter route, I will ask you to go with the shorter route. The first factors would determine and filter out majority of the retail. You'll notice that by these factors itself, you do not need to hedge. Yes, you did not hear wrongly. I'm saying that the first factors itself, many of the retail, you can easily drop the concept of hedging. Now, the concept is about the size of investment. I'll ask you a question. If today, let's say for example, you put into your stock market 25,000, is this the question that you need to ask yourself, to hedge or not to hedge as a retail investor? The size of your investment, 25,000, is relatively small. Technically, there's no tools for you to hedge. Even like just now, the easiest one, portfolio diversification. 25,000, do you really need to do a portfolio diversification or not? It's very hard for you to do it. Am I correct? That's why this is the first concept. It's going to help you to filter out if you fall under these categories, which is your size of investment is not big enough. Basically, hedge or not to hedge is not a question that you even need to ask. Like what I say, some of the things is not up to. It's like today, if you are primary school, don't ask a question right now, should I study those books in universities or not? Because that is not the time that we need to ask. Majority of us, we are not genius. We should not ask that particular question. We just focus in terms of this. So as easy as that, if your size of investment is relatively small, you don't go for hedging. You don't need to consider as well. It's not the time that you need to consider this. You consider other factors or other areas that are more important when it comes to investment. This is the areas that are a bit too far for you to understand or too far for you to consider. So if you're 25,000, it's like as simple as, let's say for example, right now our index is 1,005. If you take 1,005 times 50 ringgit Malaysia, because for FKI per contract per point is 50 ringgit Malaysia, that's equivalent to like 75,000. 75,000, if you're having a 25,000 of stocks, you don't need to use a FKI contract to hedge, because the amount is too big. Your FKI is 75,000, your stock is only 25,000. That's how you would tell me, hey, can I use FM70 to hedge? I would say that in a way, yes, but first thing also we need to consider whether the liquidity is enough or not, because based on the current market, FM70, the liquidity is not strong, so it might be harder for us. Later I'm going to discuss about these factors. So first thing that you need to focus is this particular part. If your size of investment is small, definitely you do not need to hedge. So I cut your learning curve shorter. This is not the decision, because I was being repeatedly asked this question, should I hedge or not? So at the end of the day, I noticed that the first question that I will ask people is, what is the size of investment? The rest I don't discuss first. I no need to take into consideration. Because of these particular factors, I will filter out many of you. Then you no need to go through a harder way or you don't need to go through those irrelevant path, because this will determine that actually you do not need to hedge. Definitely hedging will be the best, but at this moment is not your main consideration. Increasing your investment size, that is your major consideration. Now, I'm so sorry. The second factor is the risk tolerance. We need to come up with the strategies that suit our risk tolerance level. And if the risk tolerance level is not something that suit our own characters, our own ways, our risk profiling, etc., maybe it's not suitable as well. Now, the last factors is definitely in terms of liquidity. Liquidity from two areas. One is your underlying part, another one is the tools that you're going to use to hedge. For example, if you're buying your stocks that liquid enough from your own definition, it's easy for you to get in and get out from the market, then you might not need to consider about hedging, because you can just sell first. If the market condition is not good, if the economy is not good, the stock market condition is not good, you can sell first, for example. Then subsequently, you buy back directly from the asset itself, the underlying itself. But if your stocks is not liquid, during the downtrend, for you to get out is one of the areas that is going to worry. But another areas is subsequently, when the market rebounded, are you able to buy back those stocks or not? So if the liquidity is sufficient, you can just get out from the underlying asset itself. You no need to hedge. But if your asset itself is not liquid, you must hedge. You definitely need to hedge. So because when you hedge using, like, for example, futures, which is more liquid, is easier for you. During downtrend market, you hedge using futures. When the market rebounded, you close your futures itself. Now, second part about liquidity is you need to consider the tools that you're going to use to hedge. Also make sure that it's liquid enough. For example, just now I mentioned to you, if you're using FM70, if your portfolio is not big, might be using FM70 is not an issue. But if your portfolio is big enough, using FM70 might be an issue for you, because whether you can buy sufficient contracts that you want or not. Subsequently, when you want to liquidate your position in the market, is it liquid enough for you to liquidate or not? So as a summary for retail, I repeat, just to summarize this. First thing, to ease your understanding and to ease your selection, first thing that you need to consider is in terms of the size of investment. If your size of investment, it will help you to filter a very simple path, whether should you hedge or you should not hedge. So you're going to see majority of the retails might fall into this category of size of investment is small. That's why you do not need to hedge. Because our topic for this particular week is about retail investor, whether to hedge or not to hedge. It's nothing to do with institutional clients. That is another story. Now, so this is the first part that you need to. Now, second part, very important summary is get your hedging strategies correct. If you do not have the knowledge, I would rather encourage you not to do it, rather than you blindly go and do it wrongly, even worse. And if you don't do it, the easiest way is you just diversify your portfolio. That's the easiest direct path for you to hedge, because this is very proven, already been proven that it helps you to reduce your risk. Remember, hedging, our objective is to reduce our risk. Any methods that you can reduce your risk, that is already considered part of it as hedging itself. So I hope today's topics really helps those retailers to make a decision, a very simple way to make a decision whether to hedge or not to hedge. So before I end, please remember to give us a like for this particular video, and remember to subscribe to our YouTube channels and on your notification bell. My name is Ting Ting. I'm going to see you in our next video. Bye bye.